Here's a comprehensive daily time frame strategy using pivot points. Great. Let's break down how pivot points work in online trading, especially in Forex, and how you can use them effectively. Pivot points are mathematical price levels used to identify potential support and resistance zones in the market. They are calculated using the previous day's high, low, and close. They're widely used in Forex, indices, commodities, and crypto, especially on platforms like TradingView. Basic pivot point formula. Main pivot, or P, is calculated as P equals the high plus the low plus the close, all divided by 3. Support and resistance levels. R1 equals 2 times P minus low, S1 equals 2 times P minus high, R2 equals P plus the difference between high and low, S2 equals P minus the difference between high and low. R3 and S3 are extended levels, not always used in intraday trading. How traders use pivot points. Intraday support and resistance. Price often respects pivot levels, especially during high-volume hours. Buy near support levels S1 or S2 if the trend is up. Sell near resistance levels R1 or R2 if the trend is down. Breakout strategy. If price breaks R1 with volume, it may target R2 or R3. If price breaks S1, expect S2 or S3. Trend confirmation. When the price stays above the pivot, it indicates a bullish sentiment. Conversely, if the price is below the pivot, it suggests a bearish sentiment. Confluence with indicators. Combine pivot points with the 200 EMA to understand trend direction, RSI to confirm overbought or oversold conditions at pivot zones, and MACD for momentum confirmation. Pivot point types you may see online. How to use pivot points online, whether you're on TradingView or MT4. On TradingView, add the pivot point standard indicator. Set it to traditional for classic levels. Adjust to daily, weekly, or monthly based on your time frame. On MT4, you'll need a custom indicator. Quick tips for online trading with pivot points. These are best for day traders and swing traders using levels like S1 and R1 for entries or exits. Combine with the EMA 200 trend filter for more accuracy. Use daily pivots for intraday trades and weekly pivots for swing trades. EMA 200 and EMA 20. Sure, here's a clear and detailed breakdown of the 20 EMA and 200 EMA, how they're calculated and how they're used in trading. What is an EMA, or exponential moving average? An EMA is a type of moving average that places more weight on recent price data, making it more responsive to current price action compared to a simple moving average, or SMA. The formula simplified is EMA equals close minus previous EMA times the multiplier plus previous EMA. The multiplier is 2 divided by the number of periods plus 1, for example 20 or 200. Recent prices influence the average more than older ones. The 20 EMA, or 20-period exponential moving average, calculates the average price over the last 20 candles, such as days on a daily chart, giving more weight to recent candles. The 20 EMA is quite versatile. It tracks short-term momentum, acting as a dynamic support or resistance in a trending market. It's also great for pullback entries during a trend. In a bullish market, the price often pulls back to the 20 EMA before continuing upward. Traders typically buy the dip near the 20 EMA. In a bearish market, the 20 EMA becomes a ceiling or resistance. Traders look to short on rallies into the 20 EMA. The 200 EMA, or exponential moving average, is a long-term trend filter. It averages the last 200 candles, smoothing out price action and showing the overall direction of the market. The 200 EMA acts as a long-term trend filter. It helps define a bullish versus bearish bias. This is particularly important on higher timeframes like the daily or weekly charts. In practice, when the price is above the 200 EMA, it indicates a long bias, meaning the market is bullish. Conversely, when the price is below the 200 EMA, it indicates a short bias, meaning the market is bearish. It's also commonly used by institutions and large traders, so price often reacts significantly around it. So, let's talk about how the 20 EMA and the 200 EMA work together. When the 20 EMA is above the 200 EMA, it confirms a bullish trend. Conversely, when the 20 EMA is below the 200 EMA, it confirms a bearish trend. Now let's dive into the pullback entry strategy. You want to trade in the direction of the 200 EMA, enter on pullbacks to the 20 EMA, and, add confluence with pivot points RSI or MACD to strengthen your entry. For example, let's look at the USD JPY daily chart. When the price is above the 200 EMA, it indicates a long-term bullish trend. If the price pulls back and touches the 20 EMA, this could be an opportunity to buy. Entry confirmation would be a bullish candle, RSI turning up, and a MACD crossover. Summary table. RSI 10. Sure, here's a detailed explanation of RSI 10 in online trading, including what it is, how it works, and how you can use it in your strategy. What is RSI? RSI, or Relative Strength Index, is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and helps identify overbought or oversold conditions. Originally developed by J. Wells Wilder. RSI 10 defined. The number 10 refers to the period. RSI 10 uses the last 10 candles to calculate momentum. Compared to the standard RSI 14, RSI 10 is more responsive or faster and better for shorter-term signals. It's quite common for swing trading or entry timing. RSI 10 formula simplified. RSI equals 100 minus 100 divided by 1 plus RS. RS is the average gain over the last 10 periods divided by the average loss over the last 10 periods. If the price is mostly gaining over the last 10 candles, RSI rises. If mostly losing, RSI falls. How to use RSI 10 in trading. First, identify overbought and oversold zones. When the RSI is above 70, it indicates an overbought condition, which could be a potential reversal or pullback zone. Conversely, when the RSI is below 30, it's considered oversold, suggesting a potential bounce or long entry zone. But, don't trade these levels blindly. Always use them within the context of the trend. Next, let's talk about trend confirmation. In an uptrend, the RSI will often stay above 40 to 50 and bounce off 30. On the other hand, in a downtrend, the RSI usually stays below 60 and gets rejected at 70. Finally, we have divergence signals. A bullish divergence occurs when the price makes lower lows, but the RSI makes higher lows, which may signal a reversal up. Conversely, a bearish divergence happens when the price makes higher highs, but the RSI makes lower highs, indicating a potential drop. How RSI 10 fits into your strategy for USD/JPY. You're using it alongside the EMA 200 as a trend filter, the EMA 20 as a pullback zone, pivot points for support and resistance levels, and the MACD for momentum shift. Here's an example. USD/JPY is above the 200 EMA, indicating a bullish trend. The price pulls back to the 20 EMA and pivot support. RSI 10 drops to 35 to 40 and starts turning up. That confirms a momentum shift, which is a strong long entry signal. Let's summarize with a table. MACD 310. Great question. Linda Raschke's 310 MACD strategy is a momentum-based trading method that uses a modified MACD to capture trend shifts and short-term pullbacks. It's different from the classic MACD you usually see on charts. Let's break it down clearly. Who is Linda Raschke? Professional trader, market technician, and co-author of Street Smarts, known for rule-based trading strategies with a mix of price action and indicators. The 310 MACD is one of her well-known setups for spotting momentum shifts and pullback entries. What is the 310 MACD strategy? The core indicator setup includes a MACD with a fast EMA of 3, a slow EMA of 10, and a signal SMA of 16. This creates a faster MACD that reacts quickly to price movements. It's great for short-term or intraday setups, but also works on higher time frames like the daily chart. How it works. The 310 MACD gives you two signals. First, the momentum shift indicated by the MACD histogram. When the histogram moves from negative to positive, it signals bullish momentum. When it goes from positive to negative, it signals bearish momentum. This is used to identify the impulse leg in the direction of the trend. Second, the pullback entry. After an impulse move, the price pulls back and the histogram pulls back toward the zero line. You look to enter in the direction of the previous impulse once momentum resumes. Trading rules, typical setup, trend direction. Use the EMA 200 to determine trend direction. Only take buys above the EMA 200. Only take sells below the EMA 200. Signal entry, by example. First, price is above the EMA 200, indicating a long bias. Second, the MACD histogram was positive, then pulls back towards zero, but stays above zero. Third, the RSI, which is optional, stays above the 40 to 50 zone. Finally, enter when the histogram starts rising again or a bullish candle confirms. Exit at resistance, pivot point, or when the histogram flattens. Alternatively, you can trail stop using the EMA 20. Visual summary. Linda Raschke's edge. She used this setup to identify the trend leg, wait for a measured pullback, and enter with momentum in her favor. Top-down analysis in online trading is a multi-time frame approach used by professional traders to align trades with the overall market structure, trend, and momentum. It helps increase the probability of successful trades by ensuring you're trading with the bigger picture, not against it. What is top-down analysis? Top-down analysis starts by looking at the higher time frames, like monthly or weekly, to understand the overall market trend. Then it drills down into lower time frames such as daily, 4-hour, or 1-hour, to find the best trade setups. Why use it? Well, it helps avoid trading against major trends. You get higher probability entries and you can time your trades with confirmation across timeframes. Plus, you'll spot major support and resistance levels before entering. How it works step by step. Let's use USD/JPY as an example. First, start with the monthly or weekly time frame to get the big picture. Identify the long-term trend. Is it bullish, bearish, or ranging? Mark key support and resistance zones from history. Look for large chart patterns like head and shoulders or trend lines. Go to the daily time frame. Look for the medium-term trend direction. Use your system, 200 EMA, pivot points, RSI set to 10, and MACD with settings 3, 10, 16. Spot pullbacks, breakouts, or consolidations. Drop to the 4-hour or 1-hour time frame. Look for entry triggers like candle patterns and indicator confirmation. Fine-tune your stop loss and take profit levels. Confirm that the momentum is aligned with those higher time frames. Example, long setup on USD/JPY. Benefits of top-down analysis. Quick tip for online traders. If you trade in MetaTrader 4, TradingView, or similar platforms, use multiple chart windows like D1, H4, and H1 side by side. Mark zones on higher time frames and watch how they react on lower ones. This strategy is great for swing trading or precision intraday entries based on daily bias. Start from the weekly chart. Alright, let's dive into the top-down analysis process. First, we start from the weekly chart. Here, we identify major support and resistance levels. It's crucial to mark the weekly trend direction using the EMA 200. If the price is above the EMA 200, we have a bullish long-term trend. Conversely, if it's below, we are looking at a bearish long-term trend. Also, check if the price is near a key weekly pivot point or support and resistance zone like the weekly R1 or S1. Moving on to step 2, the daily chart analysis. This will be your main setup chart. Apply the EMA 200 to determine the trend direction and the EMA 20 for dynamic support and resistance as well as momentum. Pivot points, whether daily or weekly, serve as key reaction zones. The RSI set to 10 is used to identify overbought or oversold conditions. Finally, the MACD with settings of 3 and 10 helps in confirming momentum entries. Now let's discuss the strategy rules for the daily chart, starting with the trend direction filter. For a bullish bias, the price must be above the EMA 200, and the EMA 20 should also be above the EMA 200. On the other hand, for a bearish bias, the price should be below the EMA 200, with the EMA 20 also below the EMA 200. Next, let's move on to the entry setup and buy conditions. First, the price is above the 200 EMA, indicating a bullish trend. Next, the price pulls back to a pivot support such as daily S1 or S2, or even weekly S1. It's important that the price also respects or bounces near the 20 EMA. Additionally, the RSI with a 10-period setting should be below 40, ideally between 30 and 40, and turning upward. The MACD with a 310 setting should show a positive histogram or a line crossover. Look for bullish price action at that level like a pin bar or an engulfing pattern. Lastly, make sure this aligns with the weekly bias. Now, let's move on to the sell conditions. First, the price should be below the 200 EMA, indicating a bearish trend. Then the price pulls back to pivot resistance, such as daily R1 or R2 or weekly R1. The price should hit the 20 EMA and reject it. The RSI with a 10-period setting should be above 60, ideally near 70, and turning downward. The MACD with a 310 setting should cross down or the histogram should turn negative. Look for a bearish candle to confirm the rejection, and finally confirm this with the weekly bearish bias. Stop loss and take profit. Stop loss just above recent swing high for short or swing low for long, or place it just beyond the pivot level being used for entry. Take profit options. TP1, next pivot level for example. R1 to pivot, pivot to S1. TP2, trail using EMA 20 or price structure. You can also use a fixed risk-reward ratio 1:2 or 1:3 depending on setup quality. Example scenario. Imagine this on EUR/USD. Weekly chart shows bullish structure above EMA 200. Daily chart price pulls back to daily pivot and EMA 20 area. RSI 10 is at 35 and turning up. MACD 310 histogram just turns green. Bullish engulfing candle forms. You go long with a stop loss under the last swing low, targeting R1. Additional tips. Only trade in the direction of both weekly and daily trend. Avoid sideways EMA 200. It signals a choppy market. Don't chase price. Wait for pullbacks to confluence zones like pivot, EMA, and RSI. Use alerts or custom indicators to simplify